School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 2 Cost Accounting, Unit 6 Understanding and Classifying Costs.
After completing this unit, you will be familiar with the process of determination of cost, particularly in a manufacturing concern. You will also learn how to explain the costing techniques that are useful in the process of managerial decision making. Introduction. You will recall that Unit 1 and 2 of this course gave you a detailed outline of the conceptual framework of accounting and the role the accountant is required to play in the present commercial and industrial setup. You have seen that he is more of an advisor to the management. He functions as the channel through which accounting information flows to the management efficiently and effectively. He gathers information, breaks it down, sifts it, and organizes it into meaningful categories. He separates relevant information from irrelevant and then ranks the former according to the degree of importance to management. He also compares the actual performance with the planned one and reports and interprets the results of operations to all levels of management and to the owners of the business. In performing these multiple duties, the accountant has to make use of different management accounting techniques. Cost techniques have precedence over other techniques since the accounting treatment of cost is often both complex and financially significant. For example, if a firm proposes to increase its output by 10%, is it reasonable to expect the total cost to increase by less than 10%, exactly 10%, or more than 10%? Such questions are concerned with the cost behavior, that is, the way costs change with the level of activity. Answers to these questions are pertinent for the management accountant or financial analyst since they are basic for the firm's projections and profits. Ultimately, cost management becomes the basis for all financial decisions. It is therefore necessary for a management accountant or financial analyst to have a reasonably good working knowledge about basic cost concepts and patterns of cost behavior. All these come within the range of cost accounting. Cost accounting. In the initial stages, cost accounting was merely considered to be a technique for ascertainment of cost of products or services on the basis of historical data. In the course of time, it was realized, due to the competitive nature of the market, the ascertainment of cost was not as important as controlling cost was. Hence, cost accounting is considered more a technique for cost control than merely for cost ascertainment. Due to technological developments in all fields, cost reduction has now come within the ambit of cost accounting. Cost accounting is thus concerned with number 1, ascertaining cost, number 2, controlling cost, and number 3, reducing cost. Cost. Cost accountant is concerned with cost, hence it will be of relevance to us to understand the meaning of the term cost in a proper perspective. In general, cost means the amount of expenditure, actual or notional, incurred on or attributable to a thing. For example, if you have purchased a book for rupees 150, it can be said that the cost of the book to you is rupees 150. Similarly, if a furniture manufacturer makes a table by paying rupees 500 for timber, rupees 200 as carpenter's wages, and rupees 100 as the rent of the works, it can be said that the table cost him rupees 800. It may be noted, however, that the term cost cannot be precisely defined. Its interpretation depends on: number 1, the nature of the business or industry, and number 2, the context in which it is issued. In a business where selling and distribution expenses are quite nominal, the cost of the article may be calculated without considering the selling and distribution overheads. In a business where the nature of the product requires heavy selling and distribution expenses, the calculation of cost without taking into account selling and distribution expenses may prove very costly to the business. Further, the cost may pertain to factory, office, or other establishment aspects of operations. For example, prime cost includes expenditure on direct materials, direct labor, and direct expenses. Money spent on materials is termed as cost of materials that spent on labor. Money spent on materials is termed as cost of materials. That spent on labor is called cost of labor, and so on. Thus, the use of the term cost without background information may be quite misleading. It may also be noted that there is no such thing as an exact cost or a true cost, because no figure of cost is true in all circumstances and for all purposes. Many items of cost of production are handled in an optional manner, which may give different cost for the same product or job without going against the accepted principles of cost accounting. Depreciation is one such item. Its amount varies in accordance with the method of depreciation being used. However, the endeavor should be made to obtain the accurate cost of a product or service as far as possible. Elements of cost. In order to understand the correct interpretation of the term cost, it will be appropriate for us to learn about the basic elements of cost. There are broadly 3 elements of cost. Let's discuss them in detail. First comes material. The substance from which the product is made is known as material. It may be in a raw or a manufactured state. It can be direct as well as indirect. Direct materials. All material that becomes an integral part of the finished product can be conveniently assigned to specific physical units and is termed as direct material. Some examples of direct material are all material or components specifically purchased, produced, or requisitioned from stores. Understanding and classifying cost. Number 1. Primary packing material, for example, cotton, wrapping, cardboard, boxes, etc. And number 2. Partly produced or purchased components. Indirect material. All material that is used for purposes ancillary to the business and which cannot conveniently be assigned to specific physical units is termed as indirect material. Consumable stores, oil and waste, printing and stationery material, etc. are a few examples of indirect material cost. Now next comes labor. For the conversion of materials into finished goods, human effort is needed. Such human effort is called labor. Labor can be direct as well as indirect. Direct labor. Labor that takes an active and direct part in the production of a particular commodity is called direct labor. Direct labor costs are therefore specifically and conveniently traceable to specific products. Indirect labor. Labor employed for the purpose of carrying but task incidental to goods produced or services provided is indirect labor. Such labor does not alter the construction, composition, or condition of the product. It cannot be practically traced to specific units of output. Wages of storekeepers, foremen, timekeepers, directors' fees, salaries of salesmen, etc. are all examples of indirect labor cost. Then comes expenses. Expenses may be direct or indirect. Direct expenses. These are expenses that can be directly, conveniently, and wholly allocated to specific cost centers or cost units. Examples of such expenses are the hiring of some special machinery required for a particular contract, cost of defective work incurred in connection with a particular job or contract. Indirect expenses. These are expenses that cannot be directly, conveniently, and wholly allocated to cost centers or cost units. Examples of such expenses are rent, lighting, insurance charges, etc. Overheads. The term overhead includes indirect material, indirect labor, and indirect expenses. Thus, all indirect costs are overheads. A manufacturing organization can broadly be divided into three divisions. Number 1, factory or works where production is done. Number 2, office and administration where routine as well as policy matters are decided. Number 3, selling and distribution where products are sold and finally dispatched to the customers. Overheads may be incurred in the factory or office or selling and distribution divisions. Thus, overheads may be of three types. Factory overheads. They include number 1, indirect material used in the factory such as lubricants, oil, consumable stores, etc. Number 2, indirect labor such as gatekeeper's salary, timekeeper's salary, manager's salary, etc. Number 3, indirect expenses such as factory rent, factory insurance, factory lighting, etc. Office and administration overheads. They include number 1, indirect material used in the office such as printing and stationery material, rooms and dusters, etc. Number 2, indirect labor such as salaries payable to office manager, office accountant, clerks, etc. And number 3, indirect expenses such as rent, insurance, lighting of the office, etc. Selling and distribution overheads. They include number 1, indirect material used such as packing material, printing and stationery material, etc. Number 2, indirect labor such as salaries of salespersons and sales manager, etc. And number 3, indirect expenses such as rent, insurance, advertising expenses, etc. Components of total cost. Understanding and classifying cost. Prime cost. It consists of cost of direct material, direct labor, and direct expenses. It is also known as basic, first, or flat cost. Factory cost. It comprises prime cost and in addition works or factory overheads which include cost of indirect material, indirect labor, and indirect factory expenses. This cost is also known as works cost or production or manufacturing cost. Office cost. It comprises factory cost and office and administration overheads. It is also termed as the total cost of production. Total cost. It comprises of cost of production and selling and distribution overheads. It is also termed as cost of sales. It may be noted that some accountants do not use the term office cost at all. They prefer to use the term total cost after adding office and administration overheads and selling and distribution overheads to works cost. The selling and distribution overheads are inclusive of any office and administration overheads that may have been incurred in respect of sales. Cost sheet. The elements or components of the total cost can be presented in the form of a statement popularly known as the cost sheet. The cost sheet may be prepared separately for each cost center. It may have columns to show the total cost, cost per unit, together with the relevant figures of the previous period. Classification of cost. Cost can be classified into different categories depending upon the purpose for which information is required. The cost can be broadly classified into fixed, variable, semi-variable, and step cost. Fixed cost. These are the costs that remain constant irrespective of the quantum of output within and up to the capacity that has been built up. Examples of such costs are rent, insurance charges, management salary, etc. Fixed cost remains constant per unit of time. As a result, they decrease per unit with every increase in output and vice versa. For example, if Rs 6,000 have been paid as rent for a factory building with an output of 1,000 units, the cost of rent per unit is Rs 6. In case the output increases to 1,200 units, the cost of rent per unit will decrease to Rs 5. In case the output is reduced to 800 units, the cost of rent per unit will increase to Rs 7.50. Fixed costs sometimes are also referred to as period cost. They can further be divided into committed fixed costs and discretionary fixed costs. Committed fixed costs. They consist primarily of those fixed costs that arise from the possession of the plant, equipment, and a basic organizational structure. For example, once a building is constructed and a plant is installed, nothing much can be done to reduce the cost, such as depreciation, property taxes, insurance and salaries of the key personnel, etc., without impairing the organization's competence to meet the long-term goals. Discretionary fixed cost. They are those which are set at a fixed amount for specific time periods by the management in the budgeting process. These costs directly reflect top management policies and have no particular relationship with the volume of output. These costs can therefore be reduced or eliminated if the circumstances so require. Examples of such costs are research and development cost, advertising and sales promotion cost, donations, management consulting fees, etc. These costs are also termed as managed or programmed costs. These are the costs that vary in direct proportion to output. They increase or decrease in the same proportion in which the output increases or decreases. The examples of such costs are direct material, direct labor, power, etc. Variable costs may be said to be constant per unit of output. For example, if a factory incurs Rs 1,000 on raw materials for an output of 1,000 units, the cost of raw material per unit would amount to Rs 1. If the output increases to 2,000 units, the cost of raw material would proportionately increases to rupees 2000, that is rupee 1 into 2000. Similarly, if the output decreases to 800 units, the cost of raw material would also decrease to rupees 800, that is rupee 1 into 800. Semi-variable cost. These are the costs that do vary but not in direct proportion to output. They are made up of both fixed and variable cost elements such as depreciation, repairs, light, heat, telephone, etc. Identification of fixed and variable elements of semi-variable cost is essential for the management for planning their business activities. Different methods are available for this purpose, which we will discuss in the next unit. Step cost. Fixed costs in general remain fixed over a range of production activity and then jump to a new level as activity changes. For example, a foreman can supervise a given number of workers. Beyond this number, it is necessary to hire a second foreman, then a third, and so on. Similarly, the rental cost of delivery vehicles also follows the same pattern. Direct and indirect cost. Direct cost. These are costs that can be directly, conveniently, and wholly traced to a product, service, or job. Examples of such costs are direct material, direct labor, and direct expenses. Indirect cost. These are costs that cannot be directly, conveniently, and wholly identified with a specific product, service, or job. They include all overhead costs such as salaries of timekeepers, storekeepers, foremen, printing and stationery cost, etc. Indirect or overhead costs are apportioned to different jobs, products, or services on a reasonable basis. For example, the indirect factory labor cost may be apportioned over different jobs according to their direct labor cost. Similarly, the selling overheads can be charged to different products according to their sales values. It may be noted that the more the share of the direct cost in relation to the total cost of the product, the greater is the exactness in costing. The reason for this is that indirect costs are allocated or apportioned on an estimated basis. Some other concepts of cost. Shutdown and sunk cost. Shutdown costs. These represent the fixed costs that have to be incurred even when a factory is shut down on account of some temporary difficulties like shortage of raw materials, non-availability of requisite labor force, etc. During this period, though no work is done, the fixed costs such as rent, insurance, depreciation, maintenance, etc. for the entire plant are still to be incurred. Such costs of the idle plant are known as shutdown cost. Sunk cost. These are historical or past costs or the cost incurred as a result of a decision made in the past. Such costs cannot be reversed or revised by subsequent decisions. Investments in plant and machinery, building, etc. are some prominent examples of such cost. Sunk costs are considered not relevant for decisions concerning the increase in the present profit levels. Let us consider an example. Goa Steel Limited purchased machinery for Rs 60,000. The machine has an operating life of 5 years without any scrap value. Soon after making the investment, the management felt that the machine should not have been purchased as it was incapable of yielding the operating advantage initially contemplated. Originally, it was expected to result in savings in operating cost of Rs 40,000 over a period of 10 years. On the other hand, the machine can be sold immediately for a sum of Rs 42,000. In deciding whether the machine should be sold or used, the relevant amounts to be compared are Rs 40,000 in cost savings over 10 years and rupees 42,000 that can be realized in case it is immediately disposed of. Rupees 60,000 invested in the asset are not relevant since it is the same in both the cases. This amount is sunk cost. Therefore, Goa Steels should sell the machinery for rupees 42,000 since it will result in a gain of rupees 2,000 as compared to keeping and using it. Controllable and uncontrollable cost. Controllable cost. These are costs that can be influenced by the action of a specified member of an organization. For example, the foreman of a production department can control the utilization of power or raw materials in his department. These are therefore controllable costs as far as he is concerned. Uncontrollable cost. These are costs that cannot be influenced by the action of a specified member of an undertaking. For example, the foreman of a production department can control the wastage of power in his department, but he cannot control the power being wasted in the powerhouse itself, resulting in a higher cost per unit of power to him. Similarly, he cannot control the increase in the cost of materials consumed in his department if the purchasing department or the supplying department buys the materials at higher prices due to its own inefficiency. Such costs are controllable at a particular level of management, while they are uncontrollable at some other level of management. The difference between controllable and uncontrollable cost is of particular significance to the management. The executive concerned should be held responsible only for those costs which are within his control and not for costs beyond his control. Imputed or hypothetical cost. These are costs that do not involve cash outlay. They are not included in cost accounts but are important for making management decisions. For example, interest on capital is ignored in cost accounting, though it is considered in financial accounting. If two projects require unequal outlays of cash, the management must take into consideration interest on capital to judge the relative profitability of the projects. Differential, incremental or decremental cost. The difference in total cost between two alternatives is termed as differential cost. In case the choice of alternative results in an increase in the total cost, such increased costs are known as incremental cost. If the choice decreases total cost, the resulting decrease is known as decremental cost. While assessing the profitability of a proposed change, the incremental costs are matched with the incremental revenues. Out-of-pocket cost. Out-of-pocket cost means the present or future cash expenditure regarding a certain decision which may vary depending upon the nature of the decision made. For example, a company has its own trucks for transporting raw materials and finished products from one place to another. It seeks to replace these trucks by employing public carriers of goods. In making this decision, of course, the depreciation of the trucks is not to be considered. However, the management must take into account the present expenditure on fuel, salary to drivers and maintenance, which have to be incurred in cash. Such costs for arriving at a decision are termed as out-of-pocket cost. Opportunity cost. Opportunity cost refers to the advantage in measurable terms which has been foregone on account of not using the facilities in the manner originally planned. For example, suppose an owned building is proposed to be utilized for housing a new project plant. In that case, the likely revenue that the building could fetch if rented out is the opportunity cost that should be considered while evaluating the profitability of the project. Suppose you have a sizable deposit in a bank that is fetching you a return of 10% per annum. When your deposit is nearing maturity but can be renewed, your friend approaches you with a business proposal that is likely to earn you a return of 18% after tax. After careful consideration of the factors relating to risk and return, you decide to go in for the proposal. Obviously, you have to give tip to the existing alternative in view of the limited funds you have. Thus, you will no longer have the bank deposit. The sacrifice in the form of 10% interest on your deposit in the bank that you have to forego if you go in for a business proposal is the opportunity cost for the new alternative. Traceable, untraceable and joint cost. Traceable cost. These are costs that can be easily identified or traced to specific products, services or units of the company such as raw material and labor. Untraceable cost. These are costs that cannot be identified with a department, process or product. Such costs are also termed as common cost as they are incurred collectively for a number of products or cost centers. For example, overheads incurred for the factory as a whole. As such, they are apportioned among various products or cost centers using suitable criteria. Joint cost. Whenever two or more products are produced out of the same raw material or process, the cost of material purchased and the processing cost are called joint cost. Take the example of an oil refinery where a range of products such as bitumen, petrol, kerosene, diesel are derived in the process of refining crude oil. All these products have joint cost comprising the cost of crude and the cost incurred in the course of refining. These joint costs are then apportioned to various products on some basis. Conversion cost. The cost of transforming direct materials into finished products, exclusive of direct material cost, is known as conversion cost. It is usually taken as the aggregate of the cost of direct labor, direct expenses, and factory overheads. All these classification concepts of cost help the management in the decision-making process. For example, the segregation of cost into fixed and variable elements will help the management in analyzing the total cost. Similarly, the segregation of cost into controllable and uncontrollable categories will help the management fix the responsibilities of the different executives for unfavorable cost variances. Numerous other examples can be given highlighting the usefulness of the mentioned classification of cost. Now let's summarize the unit. In order to maximize a firm's wealth, ascertaining and controlling cost is necessary. Cost control involves controlling different elements of cost like material, labor, and expenses. Each of these elements of cost can further be classified into direct and indirect. The term overhead is used for all indirect cost. Cost can be classified into different categories: direct and indirect cost, fixed, variable, and semi-variable cost, controllable and uncontrollable cost, differential, incremental or decremental cost, out-of-pocket cost, and opportunity cost, etc. Each classification of cost has its significance in the managerial decision-making process.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Uday Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.